Ladies and gentlemen, we are here with Luke. I'm not even going to try and butcher his last name. And he's currently in El Salvador. How's it going, buddy?
I'm good, thanks. Great to be back on the show. Hope you guys are doing well today.
Yeah. Originally, we brought you on because of this tweet that you were talking about. Question for the QE isn't inflationary crowd. I happen to be in that crowd myself. So step number one, the market crashes, mortgage-backed securities price declines. Step two, CBs buy central banks buy mortgage-backed securities. They take the toxic assets off the balance sheet and swaps it for a bank reserve. The bank now has a healthier balance sheet, and now the banks have the ability to make more loans because their balance sheet is impaired. Then we get the magic word of inflation. So I'll kind of run you through my framework of thinking about this, and then we can kind of go back and forth. Me and Justin have slightly different views, but come at it from the same way. So the reason why I do not think QE is inflationary, I agree with what you're talking about. The 2008, absolutely. Mortgage-backed securities tank. All the banks in the Eurodollar system, they were absolutely screwed. So what do? The Fed comes in, they give them a massive amount of liquidity. They take all those toxic assets off their balance sheet. And what do we get? No inflation. Well, why is that? The bank may have a quote-unquote healthier balance sheet, but that is not now making them loan. There's no restraint on the banking system really since 2009, 2010. The banks can make any loan that they want, but they still aren't. Why is that? There has to be a fundamental issue that is preventing them from doing so. I agree that it absolutely could cause inflation, but it hasn't because banks aren't lending. And you need those banks to lend for those new dollars to get into the system.
Yeah, so I think when we're talking about CPI inflation and asset price inflation, there's probably a really big distinction we need to make there. I maybe the tweet was a little bit intentionally provocative here on Twitter. That's what we like to do. But I agree with the steps there, and I would argue that the QE in 2008 caused significant asset price inflation. Are we on the same page with that one?
I don't think QE really causes asset price inflation. I think it's much more of a psychological shift. You could say, okay, well, QE is bringing down interest rates, and interest rates are the reason why people need to get out the risk curve. Therefore, they're going to buy more assets. But I don't necessarily buy into that case. I think it has a portion to do with it, but a very, very minuscule amount. It's much more of the psychological shift in investors because of what the Fed's doing, which is much more of a forward guidance mechanism.
Exactly. I 100% agree with that one. Sorry, Justin. I think Joe Carlasari put a pretty good comment in that tweet somewhere that I actually agreed with. We disagree on lots of different things surrounding inflation, whether it, and obviously quantitative easing, but I think he pretty much said what you just said, Josh. It's more of a psychological effect. And I think bank lending I think banks were still making loans after 2008. The way I understand it is I think they were just doing it at a slightly decreased rate as opposed to the lead up to 2008. Yeah. You're muted, Josh.
Yeah, at a much declined rate. Let's just look at the trend line. A bank lending was just taken off. There was a great growth of all loans. And then let's just pretend there was a linear line going up where this trend line is. Just compare that to how slow the loan growth has really been since then. I mean, because of the PPP loans in 2020, it kind of picked back up, but it's still significantly less than what we would have seen if we stayed on that exact same loan growth trend line prior to the GFC.
Yeah, but let me just jump in for a second. So the problem with that, Josh, I don't think that you're wrong in saying that. But the other thing, too, is that if a bank is operating from a perspective where they believe, and more importantly, their fellow banks believe they have a stronger balance sheet, sure, they might not be making more loans. But at the same time, they might not be calling in the loans they've already made. And so rather than say something is inflationary or deflationary, or rather than focusing, I think the metric should be focusing on the amount of, broad money in the system. But just because they're not making new loans doesn't necessarily mean that QE didn't have an effect in the sense that it stopped banks from recalling loans they would have otherwise recalled. And that would have the same effect, even though it would be from the stopping the destruction of existing currency units rather than having new currency units be put into the system.
Yeah, that's my main take. That QE is much more anti-deflationary than causing direct inflation, because QE alone does not cause any inflation. It does not. QE does not get to the consumer directly, unless it's under one circumstance, if non-bank entities are selling treasuries. But that's still a very, very minuscule amount to CPI, because who's to say that the treasury's that much less liquid than the dollars in the first place, or if the Fed is buying debt from the government and then the treasury spending that into the economy. But it's still, I mean, if the banks are buying those bonds, it's still getting to the economy the same way.
So if I move forward on the assumption that I believe QE is going to boost asset prices, whether that be from a psychological effect or even a mechanistic effect of buying mortgage-backed securities, I would take the other side of that, and I would nearly make the argument that, okay, if QE boosts asset prices, and if asset prices go up, then maybe the people who own those assets feel more wealthy, and then they're going to spend more money in the economy, creating inflation. What do you guys think of that?
Justin, you go, and then I'll kind of get my thoughts.
No, it seems logical. The only thing I would also add to that too is you also might have the back end too, where sure, even if it's not necessarily boosting asset prices, if it keeps asset prices in place, preventing them from falling, people might not feel more rich where they're going to spend more money, but they might keep their baseline spend the same because they do not feel poorer. So I think it's the same thing, but rather than it's like a put versus a call.
Yeah, I mean, I agree with what we've seen since 2008. Asset prices have been going up. Is that because of QE? I'm not necessarily of the belief. I think because of all the Eurodollar denominated debt, a lot of countries they need dollar income. So there's a few ways that you can get that. You can get that through, you can buy treasuries, which is going to take down yields, or you can buy U.S. assets. And we've seen just humongous amounts of foreign entities buying U.S. U.S. stocks and treasuries because of all that dollar-denominated debt, therefore taking up asset prices, which still has the exact same effect of what you're talking about. And we're just trying to argue which mechanism is making asset prices go up, therefore have me and you feel more wealthy, and we're going to buy the steak dinner instead of the salad. So, I mean, we're pretty much in agreement. And the reason I say that is because I was talking to Mark Moss, who I know that you work with, and he was saying he was kind of talking to me about the reverse wealth effect. He's like, well, a few months, this was at the market it was either at your event, the market disruptors, or at Gammon's, and Mark was there, and he was saying, whenever me and Luke go out to dinner, Luke always gets a steak. Every single time he loves steak, he always gets it. But what happens? The Fed starts raising rates. They start doing quantitative tightening. Asset prices have been coming down. You know what Luke does now when we go to dinner? He's like, he's not getting a steak.
Bitcoin's down 85%, baby. 100% all in. I'm not buying those steak dinners anymore. That's right.
What else is going on, buddy? How's life going?
Life is good. Traveling.
Can you give us like boots on the ground, El Salvador? What's the lifestyle like over there?
So beautiful weather, beautiful people, beautiful big booty Latinas, as us gringos like to call them. And obviously, like I only spend Bitcoin here, so it's amazing. I don't need to deal with cash or dollars or banks. It's really nice. Adoption. So like a lot of people here, okay, El Salvador's a hyper Bitcoinized country. They've got 100% adoption. That's not entirely true. There's probably only, say, if I had to kind of pinpoint it, adoption's probably somewhere between 10 and 20% in the country. So a lot of the Bitcoin detractors will say, Bitcoin's failed. 100% of the country is not using Bitcoin. And, I kind of like to maybe just, say I think it's good progress to go from, say, 1 or 2% adoption to somewhere between 10 or 20 in the space of a couple of years. So that was a lot. I'll pause there. Have any of you guys been to El Salvador yet?
No, I definitely plan on going though. It seemed very interesting. Like a lot of nomads are going over there, which I love. The same thing in Colombia. There's a bunch of digital nomads, and there's a lot of interesting people down there that you meet. So I'm sure that you've met some cool people over there.
Yeah, well, that's the biggest thing about just traveling, because people in our industry, most of them are expats and nomads, and they like to travel. And I think I can't wait to go to Medellin, Josh. I'm so jealous you've been there recently, and just places like Mexico.
Justin was there. Yeah, me and Justin were down there. visiting.
Did you go there too, Justin?
Yep. Yeah. It was my first time to Medellin. I've been to Colombia before. Generally, I steer clear of South America, but Colombia is one of the few countries down there that I will try to find an excuse to.
Justin's too pretentious, and he likes to go to the Asias. So like he likes the Southeast Asia
Yeah.
crowd a lot more.
More miles, longer flights. Yeah. So I've got actually. Luke, this is one of the questions that I was talking with Josh about a few weeks ago, and it came from a Michael Saylor interview that I saw. And just a side note, whenever I hear a Saylor interview, I'm always torn on Saylor. There's some points that he says that I think he can really hit the ball out of the park, and other points where I'm like, not quite. But the person who was interviewing with him, I can't remember the dude's name, but he was a relatively big name, and he basically asked the question of Saylor, like, where do you see like the different roles of the monetary system going into? And here's what I mean by that. Do you see, for example, Bitcoin as being both the reserve asset as well as the medium of exchange? Or do you see it kind of going for one or the other? And the kind of the overall broad arch of the question was trying to find different things or trying to find the different applications for how would you use money, or how would you use a digital asset to transmit value or do a smart contract or whatever. And Saylor's response was, it's like, well, look, and this is me trying to be honest to Saylor, so I'm doing my best here. But he basically said, like, look, there is an argument that I can articulate for having something else, whether it's a digital dollar, whether it's a digital euro, who cares what it is, whether it's issued by a central, whether it's issued by a private firm, whatever. But the point is having, a digital or a selection of digital tokens, and hopefully this would be like one step above the shit coins that we see right now. What that actually means in practice, I don't know. But the key thing is that Bitcoin always functioning as this reserve asset. In other words, as you say, like, you don't want to spend the Bitcoin. Maybe you'll borrow against the Bitcoin, but the key thing is you don't want to spend it. You want to hold it. You want to store your wealth in it, and hopefully grow at least grow your purchasing power that you're going to get from it. So kind of like the two parts of this question I have is, what do you see in terms of Bitcoin? And do you think that Bitcoin itself can be both a store of value and let's say a medium of exchange? And when I say medium of exchange, what I mean is a globally adopted medium of exchange that large financial institutions will use. In other words, what I'm trying to say very politely is Lightning doesn't count as an answer to that question. Or excuse me, I would make the argument Lightning doesn't count, but that's just my own viewpoint in there. And the second thing I have, and this is more of the bigger macro thing, is do you see or do you sense that there's a tension kind of arising from Triffin's dilemma, where you can either have you can either have a unit of account be a store of value, or it can be a medium of exchange, but it can't really do, or it would be very hard for it to do both. Like Triffin's Dilemma 2.0, if you ask any digital asset to try to do both of these things.
Yes, I think short answer is Bitcoin's going to be everything. Bitcoin's going to be a store of value, and I believe it's going to be a medium of exchange, and I believe it's going to be the unit of account. I'm interested to know, I want to pick your brains a little bit. Why does Lightning not count in terms of large banks and institutions adopting Bitcoin?
So from the reason I would argue from this is that I think that if you're going to see financial institutions move into the digital space, I think they're going to want a base layer solution rather than a second or third or fourth layer. That's not to discount Lightning, that Lightning will have a time and a place for something. And I say this from my own biases. So let me be perfectly clear. This is my own bias is saying this. I would be surprised to see an adoption of Lightning, because I do not know if Lightning will have the scaling issues to scale up to that level in a way that's going to make sense.
So, me personally, the way I see banking moving forward on a Bitcoin standard is I think you're going to see like an 1800s kind of free banking era style of bankings. So obviously, I believe the banks may actually use Lightning transactions, and they'll have channels with their customers. And, if they make 3 or 4 transactions a day with the bank's going to keep that channel open with its customers. And then maybe at the end of the day, or maybe at the end of the week, I see these banks and large financial institutions maybe settling all of those Lightning transactions onto the Bitcoin base chain. That's how I see banks interacting with Bitcoin on a Bitcoin standard.
Yeah. No, I just to be clear, I think there'll probably be a place for Lightning or a layer 2 or a layer 3 solution going forward. I'm not trying to, completely discount that. Now we've lost Josh. And Josh
just
is still in.
noodling on the back end.
But I would be I've always been curious to hear people who know much more about the space than I do, seeing if number one, if they perceive a tension between a whether it's Bitcoin or whatever, right, trying to function as a reserve of value, or excuse me, trying to function as a store of value, as well as the same time also being a medium. And when I say medium of exchange, what I mean is the denomination of, let's say, a contract for natural gas, timber, or whatever, some sort of commodity type thing behind the scenes for that.
Yeah, this is an interesting question because I've been obviously most of your listeners would know about the dollar milkshake theory. I recently published an article called the Bitcoin milkshake theory because I believe as the dollar milkshake theory plays out and the US dollar wreaks havoc on all of these emerging market currencies such as like the Turkish lira or the Argentinian peso. Obviously, as these countries go through hyperinflation, I believe a lot of them will dollarize, but I also kind of speculate and say a couple of them may adopt a Bitcoin standard. But with the caveat of these countries that do adopt Bitcoin, they won't only adopt Bitcoin as their local currency fails. They're going to have to also adopt something to use as a stable unit of account, which I believe will be the US dollar in the interim term. Because like you're probably alluding to, Justin, Bitcoin's simply too volatile today to be used as a unit of account. I believe that Bitcoin will eventually be able to be used as a unit of account in the future when it's far less volatile, but that won't be until one Bitcoin's worth somewhere between $50 or $100 million per coin in today's purchasing power. So that's obviously not in hyperinflated dollars. And that's kind of when Bitcoin will be stable enough to be used as a unit of account, in my view. It still won't be stable, though, because even when the whole world uses Bitcoin, and it's $100 million a coin, it'll still be appreciating by 5 or 10% per year. So Bitcoin will be going up forever, but eventually it'll be somewhat stable to be used as a unit of account.
All right.
I would just want to say, Luke, I definitely agree that for Bitcoin to achieve its lofty ambitions, it has to the market cap has to be larger. In other words, if you're moving $1 trillion, between country A to country B in a 24-hour cycle, you can do that if Bitcoin's 1 cent. You can do that if Bitcoin's 200 trillion a coin. It just simply is a function of how many times you have to do it, or how much will you move the market. And so I certainly would agree that from like an a priori standpoint, in order for it to absorb and function, or for any digital asset, or for anything, whether it's oil, Bitcoin, you name it, to function in this role, it definitely has to have enough capacity, or not capacity, but it has to be large enough where it can handle these world flows and remittances without necessarily spiking the price. So yeah, I completely agree logically with that. I mean, I might have a different answer than besides Bitcoin, but conceptually on board.
Yeah, so we're going from QE to Bitcoin. Now, Luke, I have to address the real question.
Which is you're here, right, Josh? We've got some questions in the comment.
I saw a fantastic a clip of Luke talking about how important it is to sunbathe your balls. I'd like you to walk through the rationale there.
Well, I have seen one certain research paper published in, I think it's the 1980s, and they make the claim that direct sunlight exposure to the, let's say, testicle region, that increases your testosterone by 300%. So naturally, vitamin D is good for testosterone levels as it is. But this paper, you go, Josh.
All I need is a plant.
Oh, I heard it was vitamin D. It's like, the other
from everybody else, and I'm gonna go bird's eye, just let the sun see me.
I'll send you
as it is getting very cold in the Boston area. But next time I go anywhere with foreigners and children, I'm gonna make sure to take you up on that offer.
Hey, Colombia, the sun's shining year round, my friend. You were just there. It would have been
absolutely no clue where it would be an appropriate place to sunbathe in the old testicles.
Yeah, well, that's the challenge I run into trying to travel, because I like to get some sun on the pasty ring daily.
You may not know this, but Justin is actually scared of the sun, and anything that he can do to get away from it. It doesn't matter. Yeah. I mean, anything that we do, whenever we're walking down the street, we were in New Orleans, and no one would say it is the capital of heat over there. But if he had to walk an extra mile just to get in the shade so the sun didn't get close to him, he would do it.
You should see me in my Unabomber outfit. I've got like this get up where I feel like a hat, a hoodie, the works. So, Okay, but anyways, where was I going with this? So let's get back to the QE thing. So we had the slight like deviation. So Luke, so let me tell you, so last night and earlier today, Josh and I had some pretty spirited discussions about it.
By spirited, he means intense, virtually slapping each other.
Yeah, well, it was frank, bordering on direct, is as Sir Humphrey would say it. But this has been my argument from it, and I'm just curious to see if you were like, number one, if you agree, or if you agree, to what extent you agree. Like, well, Justin, you're right at the high level, but when you start working through the weeds, maybe not. So here's the example that I used. You're trying to put on muscle weight at the gym or whatever, right? You do your calculations, and you do your calculations correctly, and numbers out of my backside here. You need to bring in 2,500 calories in order to meet your goals and, put on muscle, etc. And that's what I feel like someone's saying is QE is inflationary. It's like, oh, well, this is just, how many calories I need to get to meet my goals at the gym. And my response to that is, that's correct, but I don't think the precision of understanding that I sense in the language is adequate to address the question. So going back to my gym analogy, yeah, you need 2,500 calories, but those 2,500 calories, again, numbers on my backside, 60% needs to be protein, 20% needs to be carbs, or however it breaks down. It's not just the number, it's, okay, what is the number actually, bringing into the situation? And so that's kind of, the first framework when I think about QE being inflationary, deflationary, or anything in between. It's okay, well, wait a minute, what exactly are we saying here? And the second point that I was making in this regard is that I think that there's also like this time horizon. And the reason I mentioned the calls and puts earlier is that if you buy a call or you sell a put, in both of these examples, you think that the underlying is going to appreciate. But you've got two different ways of going at it. This is why I remember we said earlier, well, even if a bank's not extending new loans, they might not be calling in existing loans. And so the money supply might not be growing. It might be staying relatively stable, but at least it's not shrinking as much as it otherwise might be shrinking, which I would say, if it's not inflationary, it certainly holds off against deflation, to Josh's point from a little earlier. And so my contention is that when you think back in 2020 and you think back to what the Fed wants to do, the Fed or any central bank, I'll stick with the Fed, if they actually want to goose inflation, you ultimately need more goods and more units of currency coming from a bank that are a bank's liability, chasing a relatively stable supply of goods and services. All else being equal in that regard. But in order for this to happen, the Fed needed the banks to be complacent in this arrangement. I think back to the PPP loans. Basically, banks were told, listen, you're going to make these PPP loans, and you can essentially flip them back ultimately to the Fed. Now, Josh, you are absolutely correct. No, there's a few steps, in the middle. But nonetheless, the banks create the asset on their balance sheet, PPP loan due from a customer. They create the liability, cash in your account, my account, et cetera. And then ultimately that asset on the balance sheet gets swapped out from being a loan from us, back to the bank, to being bank reserves or whatever the Fed's issuing. And then it goes off to the Fed's balance sheet. And so that's kind of my take on QE, is that I think it opens the door for inflation, or at the very least, it closes the door on deflation. Now, that might be saying the same thing to an extent. I'm not trying to mince words. I'm just trying to say that I think you've got to look at it from both these angles. But I would also add this. You have to have the, not complacency, but the compliance of the banking system in the equation as well. And the silly example I use from that, when I was talking to Josh about this earlier, if you were to like airdrop $1 million into everyone's account, your account, my account, right? And then if nobody were to spend the money, that would actually not be inflationary. Yes, we would all have, this million. It's like having like a gun that's loaded. Sure, the gun's loaded and you can start firing, but until you actually pull the trigger, it hasn't happened. Now, the potential is certainly there, and I would say you're in a much more dangerous situation. But until you actually have the velocity increase, or pardon me, if you bump up all the money, if you increase bank liabilities for us, but you suddenly decrease velocity, you're not going to see any difference, because the decrease of velocity is going to temper the effects of inflation. So that's kind of like where Josh and I ended last night. I think I did a good job there, Josh, in going through all that. I was just kind of curious to hear your take on that one, on that line of thinking, Luke.
I honestly think that's actually brilliant. I agree with all of that. I actually haven't heard anyone ever say QE opens the door for inflation and closes the door on deflation. I as you said that, I just thought that's a brilliant. I've never heard anyone say that before. You should quickly tweet that out before I steal it from you, and I'll tweet it out, because I think that's a great way to think about it. Obviously, like QE, whether it's inflationary or deflationary, it's a very nuanced conversation. We can get into the weeds and start talking about bank reserves and all of the nuances of QE, and I think a lot of people get lost by that. I think that's why the money printer go burr meme in 2020, it was such an interesting meme, because maybe it wasn't, 100% technically correct, but I think that meme can give a lot of people and a lot of normies, I suppose, a directionally correct kind of framework, or a directionally correct heuristic to play out the next 10 or 20 years. Because I think, largely, as we've kind of discussed at the beginning of this chat, QE opens the door for inflation. So if you see central banks all around the world engaging in QE, maybe buying protection against that is a good thing. Protection can be different things for lots of different people. If you're in Argentina or Colombia, maybe protection is buying US dollars if you see your local bank doing QE. I would argue a better form of protection would be maybe hard assets like gold, and in particular, my personal favorite, Bitcoin, because they have actually performed best since the monetary debasement of the 2020s. Bitcoin's still up 400% since 2020 when the money printers got turned on. I think a lot of people are looking at Bitcoin, and I've been copping a lot of flack recently. Bitcoin's down 75%.
I'm actually shocked with how well Bitcoin has performed. I mean, it's very difficult to get it below 20,000. I don't know what we made a bet. I forget what the number was. I think it was slightly sub 10,000, something like that. And I forgot. I think it expires in May. It was a call option for a steak dinner, and we're going to do that in Colombia, where the maximal spend is $20 either way. But I'm very impressed with the price movement, because to me that signifies that there's still some strong buyers out there. And I mean, I would never tell Luke this, but I'm very optimistic on Bitcoin long term.
You don't need to do that. Justin knows that I'm far too confident on Bitcoin already. And don't you worry, Josh, I certainly have not forgotten about that steak dinner. It was 10K.
What number we shook on?
I'm going to say it was 10K in May.
Something like that, yeah. We'll see. I would still take my side of the bet if you bet me right now. I mean, look at everything that we're seeing in the financial system, with the 3-month, 10-year disinverted. The Swiss National Bank is getting all these dollar swap lines. It seems like fragility is building. I would not be surprised to still see Bitcoin cross 10,000. If not, fair be it to Bitcoin. It's performed really well.
Can I quickly agree with that before you jump in, Justin? I think the possibility of Bitcoin going to 10K is still a possibility. Anything's a possibility. Bitcoin could go to $1,000 tomorrow, because I agree with Josh, your synopsis of the current financial system. The global financial system's never been more broken than it is today. And obviously, but I think personally, there'll be a time and a day when Bitcoin decorrelates and decouples from the financial system. And I think a really interesting example happened in Europe and the UK over the past 2 weeks. The week that the Bank of England came out and said, yeah, boys, guess what? We're going to start printing money again, baby. We're going to start engaging in QE while inflation's above 10% to bail out the pension funds. What you saw was one of the largest daily volume spikes in terms of people trying to buy Bitcoin with British pounds that you've ever seen in history. So what you saw is more people were trying to buy Bitcoin with British pounds last week during that little QE situation than during the entire 2021 Bitcoin bull market. So I don't know. I thought that was very interesting, and that just kind of for me.
That is really, really cool to see, and I'd love to see that everywhere across the world. When you see Sri Lanka going through tough times, they start piling into Bitcoin. Of course, some people going to dollars, some people going to gold. If a small enough portions are going into Bitcoin all across the world, that's all it takes is to kind of spark that network effect to grow and grow, and then you really could get something going.
That's kind of how I see the dollar milkshake playing out.
That's a really, really good point.
Justin, I cut you off before, my friend. What were you going to?
Oh, no. What I was going to say was the I think an interesting side bet too would be to see if well, first thing is you mentioned you're starting to see Bitcoin decouple from the markets, which I'm glad to see Bitcoin's doing. The other thing I find interesting is that you're seeing bonds coupling with equities. In other words, that instead of being inversely correlated, they now seem to be directly correlated, which is well, that has issues in itself. And the second thing would be that gold's performance for the year. Yes, gold is down, but it's not down as traditionally, it's not down as much as you would otherwise expect it to be. And so I'm wondering if the hard assets are starting to rear their head. And the last thing I'll say, at least as far as commodities go, there was a screenshot I saw yesterday from APMEX, a precious metal dealer, who was basically running a special where they were offering $10 above spot to pay for, or to basically buy back Silver Eagles. And just kind of, the comment I note in this is I suspect everyone here has, actually, I shouldn't speak. Let me only speak for myself. I have concerns about how the metals are currently priced, whether it's COMEX, whether it's LBMA. I just find it very suspicious. If an ounce of silver is $20, why is there a $10, a 50% premium to buy it back? That doesn't seem to be reflective of the true cost of the underlying commodity. And this is when I think of Bitcoin's nice strengths, is that when you have a central finite supply and you have no entity that can print, paper Bitcoin or paper silver or whatever, you probably have a much more accurate mechanism for price discovery than what you're seeing elsewhere. So,
and the big thing about Bitcoin too is I'm not sure gold and silver will ever be valued appropriately. Like there's 300 to 400 times the amount of paper contracts than there is the amount of physical actual metal in these bullion banks. But with Bitcoin, that's very different because I personally think exchanges right now are rehypothecating Bitcoin. But Bitcoin's different because it's so easy to take delivery. And like what you've watched over the past 2 years is 35% of all the available Bitcoin for sale on exchanges evaporate. It's all been scooped off exchanges and put into the wallets of long-term holders. So if that trend continues over the past 2 years, where 800,000 Bitcoin have left exchanges, you get to 2028 and there's all of a sudden no Bitcoin left on exchanges. And because it's a transparent blockchain, you can actually see this happening on chain. So there's no question in our minds, Justin, as to, okay, is there bullion at JP Morgan, or, if I'm buying physical gold and silver, how much is left in the banks until the short squeeze happens? In Bitcoin, it's very, very transparent, which is interesting.
Yeah, and just to build on something you said, it's also very easy to take delivery. I'm not saying you can't do it with metals. I'm just saying it's a little easier, I think, to do with digital assets than it is with metals.
Yeah, so Luke, I know you have your Latina girlfriend coming over right now. So where can we find you?
So I'll be on Twitter. My handle is the one on screen, so it's just at Luke Mikic 21. I've got a YouTube channel, so it's Fix the Money, Fix the World. I have 2 YouTube channels. The other one's called Bitcoin Made Simple, and I do lots of writing over at Amber. They're a Bitcoin-only educational platform. You can buy Bitcoin over at Amber, and they're also helping with all the production and the Josh, you need a haircut. I thought that comment would be directed at me, but
similar haircut rocking right now. So it's because they have a running joke that I need to shave my head like Justin. Yeah. All right. So I know that you also started like a more health YouTube channel, which I'm much more interested in because I'd love to see some more tips like sunbathing your testicles as the health benefits untrue in our favor.
Yeah, that actually is a thing. There's a small YouTube channel, hasn't got a video on it yet. It's called the Australian Digital Nomad. You're going to see all sorts of outrageous videos that aren't allowed to be posted to the more business-oriented YouTube channels where we talk about Bitcoin and macro. So stay tuned.
Yeah.
Yeah.
Cheers.
No. Yeah. That's a good way of doing it. Very good way of doing it.